is also one of
with Insight and many other VC firms to help on things like technology due diligence and post-investment renovation of investments along the way. And Steve and I have actually worked together in previous companies as well. Steve is starting a new practice within Crosslake, which bridges the gap between the technology group and the product group. And one of the things that we wanted to do today in this session is help the technology and product people surface the best information that they could to the leadership teams in order to kind of help deal with our new reality, which is the opportunities that have been surfaced through COVID and the remote work trends and the digital trends, as well as being able to look at the impact of the recession. We all have to start doing more with less, and often the business leaders don't actually know the questions to ask the technology and the product people in order to surface the right strategies and discussions at the strategic table. So this webinar is designed to help the product and technology people think about the questions or information they should be surfacing to the leadership teams in order to help drive a better strategic direction for the company post-COVID and the recession that ensued following it. So with that, I'm going to hand it to Steve to start the discussion, and we will be going back and forth throughout. And as I said, please make sure that you ask questions. We'll be taking questions and during the presentation as well as at the end. Thanks.
I won't even try to introduce you, Shelley, so all good. Yeah, so hi, everyone. Thanks for the time. From an agenda standpoint, three real important things to look at. So as Shelley said, we're going to look at the current realities and frame them as an opportunity, not just to stay where you are, but to actually gain ground and move ahead. To work with your CEO and your C-suite to understand what the updated business guidance is, and then in your role in the product and the tech orgs, how to align with those goals and achieve the mission. And then lastly, how to work with your investors to potentially advance your strategy, provide some optionality, and do it in an efficient way. All right. And for all of us old enough to have seen these downturns before, there's typically three classes of companies. There are ones that are going to fall behind and get knocked out. There are going to be companies that make cost cuts and they tread water. And then the third category is really about the companies that can figure it out and actually move ahead. And so our goal today is to give some guidance potentially for early and mid-stage scale-ups on how you can put yourself in that third category, again, to look at the opportunity and to make decisions and make the trade-offs necessary so you can be in that category of the 14% of companies that actually come out ahead of these types of downturns or recessions. And with that, I'm going to hand it over to Shelley. We're going to tag team on this, and she's going to talk about the scale-up journey and beyond.
I want to just step back and look at kind of what has happened over the last decade or so. There's just so many more companies that are in the scale up, or sometimes called growth phase. And it's important to realize kind of the trajectory that we were on post-COVID in order to, or pre-COVID, I'm sorry, to kind of understand what we should be looking at post-COVID and the recession that ensued. So a scaled enterprise, one that is much larger, whether you've been acquired into a scaled enterprise or kind of grew with a scaled enterprise, by design, as you scale and as you go public, you get much larger, and it is critically important that you deliver to this stakeholders or shareholders value. And a lot of the efficiencies come through maturing processes and optimization. There's also a lot more scale, so you have more levers that you can pull in a scaled enterprise. And things don't change as rapidly in a scaled enterprise because, in fact, they're much larger and they don't have the ability to change certain things without affecting the shareholder numbers or other divisions. So they tend not to work as fast or change as fast. The later stage scale up, if we kind of go down, is getting ready to be a scaled enterprise or going public. And so you start to see things around switching from kind of customer long-term value of a customer, being able to cross-sell to your existing customers because that helps to reduce CAC. You're starting to optimize more than you would have. And that, again, this is kind of pre-COVID. At the mid stage, you have ramped up sales. You ramped it up in the first stage. You're ramping it up to the second, to really getting much more efficient in your sales and marketing strategy. You have a lot of analytics in place for sales, a lot of analytics in place for marketing to understand what's working. And you're starting to expand your product or expand your portfolio into your expansion strategies. But it's early on in that phase. You typically will scale up sales and marketing before you scale up product, because you have to kind of get that revenue coming in order to kind of help fund additional product investments. And then in that early stage of scale up, it's the post-market fit. What you're doing in that stage is really starting to ramp up sales. You're starting to get repeatable material on sales. You are ramping up your marketing, but really kind of focusing on sales, and you're hardening your product and tech, but you're not necessarily expanding because you're trying to kind of keep up with the growth in the organization. And then, of course, when you're startup, you're lean and mean. That's what the old world looked like. If you kind of focus on the three stages of scale up, the optimization stage is really in that later third stage. And now, as we're looking at the recession and kind of trying to figure out how we're going to do more with less and make things count, we'll talk about where that's going. So what's changed? Look, pre-COVID, it was grow at all cost. As a scale-up organization, the opportunity cost to put in too much optimization early on would have cost you probably in growth and therefore valuation. It didn't mean that you weren't optimizing. It meant, and you may have known what it would take to optimize. It means that you might have reallocated your resources to growth over optimization, because you could optimize later in the cycle. And that's in fact what the market encouraged you to do. And everybody was buying. So adding new solutions faster so that other companies could buy it and benefit from it was what you should have been doing. And so externally, that has changed. And just like you're pulling back on costs and where you're allocating things, so is the rest of the market. There's a few areas that COVID has induced in terms of the digital transformation. And so there is an exception of category of companies that this is not affecting, but for the bulk of companies, this is really the reality of today. We can go to the next slide.
I think the next slide's me.
Thanks, Steve. Steve's driving for us today. So, what is the understanding of the new mission? Your CEO and your board and your C-suite, and many of you are on that, really they looked at the P&L. What they do is they kind of understand that P&L, which is a summary view. What they're not looking at, because that's your job, is what's underneath the P&L. What do these changes mean? You are the only ones in the organization who really understand some of the technology details that are under there that kind of roll up to the P&L. You're the only one that kind of understands some of the product-specific trade-offs, the technology-specific trade-offs. And quite frankly, the CEO, in most cases, unless it's a founder CEO that has a technical background, really doesn't have the experience to even ask the right questions. And that's your job to actually help surface that information so that you can have different discussions. And the strategies and vision that you had for your products and tech before COVID will have to change. There's not an option that they can't change. Either you're taking advantage of the new market opportunities, or you are dealing with kind of lower sales levels or an extended runway for your cash. So there is absolutely no way that a pre-COVID vision and strategy should not be changed post-COVID because of the recession. And you need to understand what drivers your corporation or your scale up is looking at so that you can participate and surface the information, because they don't always know the right and best questions to ask.
Yeah, so I mean, the way I see it is, you went into 2020, you had a plan. Now your plan's going to change, and so it's super important to understand that different stakeholders are viewing the business at different levels. So your investors are looking at impact evaluation and time horizon. Your CEO's got to deal with that, but they've also got to look at the P&L perspective. And so the job of the product org is to understand for those lines in the P&L that are in play, what are the trade-offs you can make, and then express them to your leadership in a language that they understand. So it's basically putting together the business cases and the options and then expressing them. So as I like to say, you need to use terms like ARR, gross and net retention, gross margin, and avoid sprints, story points, NPS, and the other technical jargon. And again, the role of product and tech is to really figure out what the trade-offs are from the product side as they impact the line items on the P&L that the CEO has set forth. And so the real call to action here is, as I say, put yourself in your CEO's shoes, if CEOs are wearing shoes these days anymore. Give them what they need in the way that they're used to seeing it, in the way they need to ingest it.
Before we move off the slide, I also want to say one thing, that look, you may not kind of understand what some of those P&L terms mean, and even some of the terms that Steve just said. And you may think that you have and have been telling your team kind of what some of the issues are. But most of the time you're telling them especially if you have a technical background, and I come from a technical background, and so does Steve. And often, especially earlier in my career, I thought that I was giving them the information that they needed. And what I realized is that it was just I thought it was so rolled up because I would never talk to the technologist that way. And I thought it was a rolled up view of course they needed to understand what I was saying. And the fact of the matter is there's such a disparity between the business language and the technology language that oftentimes you need some help kind of translating that. So if you are working with an insight company and you need some help with that, you can and should raise that so that we can help with the translation between that. You'll start to learn it. It's something that you should be learning, but often you think that you're telling them things in a way that they can understand, but there is such a mismatch. And it's not because they're not smart, it's that because they have not worked in the deep technology realm, and the words that you're using just don't mean anything to them in a business perspective.
Yeah. And so let's talk a little bit, practically how to do that. So let's take it as a given. You made some initial cuts. You did what you need to do. There was a good Crosslake webinar on cost-cutting procedures and a roadmap to follow for that. So quick plug for that. You can check out the Crosslake YouTube channel. So as Shelley said, you have the guidance at the P&L level. So now you need to step back and make some thoughtful and hopefully data-driven decisions. And so the way that you do that is that you look at the levers that you have, right, for product changes, technology changes, and then run them through a process that says, what's the impact on the top line? So that would be revenue for net new customers or retaining existing customers, right, because they both count towards revenue equally. From a bottom line perspective, what's the impact on margin and EBIT if those are guidance in the P&L? So again, if you're early stage company, cost may be less important. So get guidance from your CEO so that you're very clear. Is this about maintaining the top line? Is it about the costs? And then lastly, also look at any other metrics related. So it could be revenue recognition for SaaS companies. It could be cash flow. Obviously, during difficult times, cash flow is important. So again, you get the metrics from the top level on the P&L, both on the revenue and the cost side of the house. Look at other elements such as cash flow, and then map the changes you can make to the product in terms of features and overall products. And we'll talk about packaging and product features a bit later, but that's typically how to run through this. Now, we talked about numbers, top line, bottom line. And so to do that, you really have to have a fundamental understanding of the nuts and bolts of your business. And so let's move on and talk about that a bit. All right. So in general, we talked about the journey from startup to mature scale up. And so the challenge is that if you're in the early stage or mid stage, you've got to continue to do what you were doing before, which is to innovate, get product market fit, grow at all cost. But now you've got that additional pressure to do what mature scale-ups are supposed to do, which is to understand how to operationalize your business. And you need to know all your numbers in order to be able to do that, especially as you're trying to get to EBIT neutral, cash flow neutral in the later stages. And so that means you really need to be able to drill down on 4 things. So one is the value that you're providing to your customers, and we'll talk about a little bit how to do that, right? So that feature value map. A real focus on ROI with the understanding that ROI time horizons have shortened. So in the past, if customers were looking at an ROI maybe over 12 to 36 months, maybe even shorter, maybe over a couple of quarters to look at their spend and their return. Ask yourself the question, for every dollar of budget you spend within the product and the tech org, what's the biggest value to the org? And think of it across the entire customer life cycle. So that's onboarding, support, billing, collection, right? Those are all contributors to the cost elements of what you're doing, not just the development of the product itself. And then lastly, keep an eye out on the competitors, right? They're not standing still either. They're making changes, they're moving. And so make sure that you're looking at what the other competitors in your space are doing and adjusting your strategy accordingly.
And Steve, let me just add to this. Look, in the last kind of 5 years plus, if you've been working in a vendor or a software development vendor where you're shipping software to someone else, you may not have the experience, or if you had it, you haven't been doing it in a while, of kind of a systems architecture and kind of looking down or looking across the way your customers are using your solution. And one of the things that has happened when we talk about looking at the competitor, it's not what is your direct competitor, but what is your adjacent competitors as well. Because when you step back and kind of look at the ecosystem that your customers are using, look, they might have multiple scale-up software solutions in their enterprise. And those scale-ups have changed. They put them in and then they expanded. They put yours in and yours expanded. And before the recession hit, there was an issue of probably having both the vendors in there, even though they started to overlap. And so one of the things that you need to be looking at is where is that overlap, because they're also going to be trying to pull back costs, and it may be that they will de-implement one of the solutions in favor of just saving costs, because your solution does these 5 things and this solution does these 5 things, and there's an overlap of 2 of them. Even though yours may do it better or theirs may do it better, they're going to have to make tough choices. So I would encourage anyone in the audience that is technical and has had the experience of understanding how to look at those system diagrams and kind of understanding kind of where you sit in the ecosystems of your customer. Now is the time to exercise that skill and be thinking about it. I don't think it was as important in the last 5 years because there was a tolerance for a lot of overlap and costs in the enterprise to try new things, to innovate, and to save costs.
Yeah, so the same process you went through to reduce cost, your customers are going to do that, so they're going to be looking at you in the same way. So really pay attention on the retention process. You may want to move that up a quarter or 2, right? Understand what's sticky, have CSMs be in touch with customers, but keep an eye on it. So we talked a bit more about later stage startups being able to operationalize and make data-driven decisions. And so one of the important elements that Shelley and I push is capability called product operations. And product operations enables data-driven decision making in 3 areas. So it's really about capturing key data elements of your business performance: sales, marketing, finance, and of course engineering. The ability to visualize that data, and then taking that data and then understanding the leading indicators or cohorts between the actions that the product org is taking and then the results in the real world from a financial perspective. Importantly, these are tools. You still need brain power and a subject matter expertise and understanding of your business and your market to drive that causation or those cohorts or leading indicators. But product operations is a mechanism to do that. I typically like to group the engineering elements of product operations into three categories. So the first is velocity, which is how fast is your org moving from what you've committed to from a roadmap perspective. From a quality perspective, bugs, and then scalability and performance as you're putting more demand on your infrastructure. And then lastly, how are you tracking from a cost perspective, staffing, tooling, and infrastructure? And then on staffing, typically, Shelley likes to break it down in 5 areas. One is operations, or keep the lights on to maintain the product. The second is retention, which is the base level of support you need to retain your customers. New customer onboarding is a third category. Sales debt, which is the fun stuff that salespeople rack up to close deals that the product org now has to deliver. And then lastly, innovation, which are new product features and the balance between those. So those are the elements that we capture in product operations. Accurate data is super important to be understanding the causation. I'm not saying it's that formula in the bottom right, which we'll have a quiz on afterwards. But as an example, for those following the COVID data, a tiny change in the numerator makes a huge difference on the subsequent data, right? So we've seen that with COVID statistics being in the news. So key takeaway here is a small change in the data can really have a big impact on the result.
Let me just add something to this as well. Insight invests pretty heavily in helping our portfolio companies with product operations as part of the product COE and in partnership with Product Labs, who is part of the product COE at Insight. We have a capability that we offer to help get our companies up and running on the base of product operations. It is so important to Insight that this becomes a core part of what you do, that we offer a starter for that. And if you're interested in it, please make sure that you are asking about that in the community, and we will absolutely help you get started with that. There is a lot to product operations, and we know it's hard to get started, so we kind of offer a kickstart to that and then expand out to other partners to kind of help extend that functionality.
Yeah, and importantly, sometimes the getting started with product operations can seem daunting. So the bottom line is, if you've got product operations capability, now is the time to leverage it, really use it. But if not, it's not an all or nothing. Start now. You can do some manual baselining and get some results from a manual approach. As you scale, you're definitely going to need it. So now is the time to leverage it if you have it. If not, get started and figure out how to get a Pareto of value in terms of a certain amount of effort and get the maximum result for now. All right, so a couple of ways I'm going to let Shelley run with this in terms of how you can evolve, or frameworks for evolving your evolution and your packaging during these transitions.
Okay, I think one of the things that the product and tech groups can help with is an understanding of how your application or product is being used. When you're in the scale-up phase, or you've come from startup into the scale-up phases, you have created product packages, because those product packages are easy to enable the sales organization and for customers to get their head around, and you make your best guess on what the right pricing and packaging should be. What you really need to be doing, especially during the scale-up stage, is looking at how your applications are actually being used by specific cohorts. What that allows you to do is potentially create alternative packages. Now, you're not going to be doing that on the fly. You're going to be doing that in combination with your sales, marketing, and financial groups, but you should be surfacing how certain cohorts are using your applications, specifically which features and functions and how much those features and functions cost, because you make your best guess associated with that. And often we project the cost of build, we don't project the cost of the run of those features. And one of the things that we have found is that when you get into an advanced kind of product ops capability, you start to really look at how it's being used and how much those features cost at runtime. And you start to be able to suggest alternative packages, which we call kind of value-based pricing and packaging. It's an advanced capability. It is something that almost every single scale-up company has not done very well until you get up into that later stage and you start looking at optimization. And it's something that we now need to start bringing in earlier in the scale-up stage. And product and technology groups need to be surfacing that information, even if you are not involved in the pricing and packaging. There are some product people who kind of run that, and in some organizations they don't. But you need to be surfacing this information because it's one, it's going to help with retention, but two, it's going to help with coming up with alternative packages. And the view that I talked about earlier about understanding where you sit in your customer's ecosystem, that creating packages that are slightly smaller and maybe a little bit of price degradation for a little bit of less features that they're not using anyway, they may have a big cost implication for your runtime as well. So you can actually get the customer happier. Yes, it's slightly less revenue, but you're not giving a discount on features they're not using, and you can save costs on runtime. And that's why it's extremely important that you not only understand what the build costs are, but the run costs are by grouping of features. I don't care what the product umbrella says. I care about what is the group of features and how much do they cost, so you can start making more informed decisions that, quite frankly, you did not have to make over the last 5 to 10 years in our wonderful bull market that we experienced. You do need to start looking at those things now and surfacing them. And most people don't understand that you actually have the ability to do that. They don't even ask the questions because it's only recently that there's technology that allows you to do that a lot easier than it used to be. So a lot of people who haven't worked in the details of the technology, especially in SaaS solutions, don't understand that there is that capability to actually surface that information and then start to make decisions on it. The last thing that I want to say is, look, you may have spent a lot of money on something. You may have, and that's the sacred cows at the end, you may be 80% done with something. All of us know that in development, that last 20% is actually quite costly. And it's not just your cost in the development and product area. It could be the enablement cost. It could be the support cost. There are absolutely no sacred cows, and you need to be analyzing everything that you've done, everything you have in flight, and suggesting things that you may stop doing now in favor of opportunity costs for other things that weren't even on the radar because perhaps the digital transformation wasn't happening as fast. So look at everything, question everything. And again, I want to reiterate the fact that if you need some help kind of understanding how to look at certain things, or how to translate certain information to ask the right questions, it could be the difference between your company doing, fantastically well and only okay. So if you need some help with that, reach out. There's lots of resources to get help with that.
Yeah, last thing there is when the business cases for some of these features or functions were done in an enthusiastic environment, right? And so you get 80% of the way there, you may need to look at reviewing the business case to say, okay, this was expected to generate X amount of top line. Is it still going to do that? And is this the best use of resource within the product org based on the realities?
So I want to talk a little bit about intelligent packaging, or ways to kind of think about your packaging or prioritization. We talked about retaining customers. Look, right now you need to keep all of your customers, as many as you possibly can, even if that means kind of downselling or downgrading to kind of smaller packages. If you do that, just make sure that you are also giving them a package that has reduced features in it if they're not using them. What that allows you to do as their business improves, as the market improves, you can kind of cross-sell or upsell the new capabilities to them that you have probably advanced anyway during that. So you must retain customers. There's going to be some leeway in terms of the growth rates, especially in 2020, they're unpredictable. And so not having as high growth rates as we had originally predicted in 2020 isn't going to be as important as losing your existing customers. So help kind of interrogate some ways to help keep the solutions there, and don't take for granted that just because you've sold something or just because you're in an enterprise or have sold that it's going to stay there, because they're looking at solutions just like you are. Reinvent pricing. That means it's not really reinvent, it's kind of is look at different pricing and packaging strategies to to value-based solutions to kind of match what companies need. And you may not think that you have the capability in your monolith to actually do that, but there's lots of ways that you can do wrappers and technology wrappers around that monolith to meter it, to kind of do different things that you may not think are possible from a technology perspective. And that's one of the areas I think that Crosslake helps a lot with, is kind of helping to look at that tech and do some creative things with it that you might not have thought that you could do. And that's just because they work as well as I do across multiple instances of seeing these different technologies and being able to leverage some ideas that people have had to think creatively out of the box. But you really do need to be thinking about different pricing and packaging, and a lot of that rests on how the technologists can kind of break that up and kind of feed to the metering and feed to whatever billing system is there. And so think about ways that you can help the business leaders with new ideas that you might have not thought possible before. The next is that you can kind of align your approach to kind of bundle. You can look at, are you going to go kind of wide instead of going up to the enterprise? You might offer things that are adjacent, because going up to the enterprise, if you have a solution today that is intended to go to the enterprise, but it doesn't have all the capabilities in terms of security, in terms of integrations, in terms of some things that the enterprise absolutely has to have, one of the things that you can do is start to offer a best of suite in the next couple of years that go sideways. You can chip away at those enterprise requirements, but you can still retain revenue by being able to sell adjacencies, and then maybe in a year or two kind of go to the enterprise. It doesn't mean you're not going there. It means you may take a detour in your selling motion so that you can slow down some of the development. These are just ideas. Slow down some of the development or decrease the amount of sales debt that you might incur by selling to an enterprise too early. And these are, again, some of the things that you need to surface that only your skill sets that are on this would really understand to help facilitate that conversation. And the next is, if you are kind of enterprise focused, look at add-ons. Maybe you have a solution that really has a lot of friction in the sales cycle. Is there a way that you can create a portion of that feature to just be an integration to an existing platform? That way it gets you in the door, it gets their experience with you, and then later when the market picks up and they're willing to kind of displace a system that they already have, then they'll look at you for the rest of it. So you may have wanted to be like, we are going to be the system of record for XYZ, and we're going to sell the whole package. You might need to start looking at, is there ways that I can get into that enterprise with these smaller modules because they don't have as much friction in the sales cycle, and then actually come in and sell the core system, which I think in the past, if you had a core system or system of record, you were trying to sell that first with everything else around it. So be thinking of that. I know, again, those things are not easy from a technical perspective, but if it was easy, we wouldn't need you. So that's what I'm challenging you there. Next one, Steve. So look, I'm going to talk about a few scenarios that you might be dealing with, and that is, and again, you should be discussing this with your leadership team, and hopefully you have an understanding of what it means. But look, you might have a flat projection of growth, which means that you need to make sure that you're keeping your current ARR, your current revenue, your current customers, or at least that level. And it might mean that we talked about this a few times, but it's that thing about creating kind of some smaller value-based packages so you don't lose that customer. You might also want to introduce freemium, where I know a lot of enterprise solutions, or the speed to the enterprise, are like, why would I want to do a freemium solution? Why would I be giving away something free when I already have it? Freemium solutions are actually subsets. They're a different packaging. They aren't the same product. I think one of the best examples, or two really good examples that kind of illustrate an enterprise freemium strategy is Dropbox and Zoom, right? You get a 45-minute taste, or 40-minute taste. You have all these different things, and all of a sudden you start opening it up. So you really need to be thinking about your packaging strategy and offer freemiums, because it's going to win the hearts and minds. And although you may not get immediate sales today, it may lead to a more cost-effective sales cycle over the next year and a half. It is not offering the same solution that you offer to your enterprise. It is offering a different package. Next one. This one is this one is about increasing partnerships with adjacencies. So many product and tech people think about partnerships as being outside of product, because the product, often we think of it as being in the tech as being something we build, when in fact in SaaS, the ecosystem of who you integrate with and what your solution provides through integrations is just as much a part of the product as it is partnerships. So in the past, you might have thought, our vision for the product is this, our roadmap is this, or our strategic direction is this, and we are going to own the universe. We're going to own the world. I've been in conversations that says we shouldn't be partnering with other people because they're an adjacency. You need to rethink that strategy. You need to look at your adjacencies around where you're building. You need to look at your roadmap and look at what you think you're building, and you need to look at yourself in the mirror and say, there is no way that we are going to build that in the next year and a half. It may be in 2 years, but in the next year and a half, we're not going to build it. Find adjacency partners that are around the same size that you are. Don't go to Salesforce or some of the big guys because they are bigger. They don't have aligned incentives as you have. Go to the adjacencies that are around the same size and form partnerships so that you can sell with, sell through, and offer advanced features to your customers. You will both win by doing that. And that is something that just wasn't done again until later stages of that go-to-market strategy. You need to start earlier in your product and tech planning. So if you're looking at what your customers are integrating to, and the technologists have a lot of information associated with this, surface the information of where those calls are coming from so that we can go have, or your teams can go have those conversations with the adjacent platforms that you're already integrating to. That's a really easy win there. This one is revisit your expansion strategy. You may have thought you had more funds than you had a higher growth rate, and you might be thinking about that you're going to be expanding into this adjacency. It really goes along the lines with the partnership. You might have thought that you were going to add, some big enterprise capability versus going adjacent. You might have thought you were going to add a marketplace to something that you had. You need to revisit those expansion strategies. And one of the things that you want to make sure that you do is that any expansion strategy you have is being sold to the same type of cohort that you're currently selling. It takes a lot to sell even within an enterprise, to sell something to a different buyer. So when you're looking at your expansion strategy in the near term, you need to make sure that whatever you're expanding is selling to the same buyer, because that will help your sales and marketing team kind of contain those costs. So that we have some things on the Insight blog about expansion strategies as well as the community. So if you want more information around what expansion strategies are and how you should be thinking about them, we do have some information available for that. Last one. Buy versus build versus partner. This goes with the partnership, but this looks at it and says, is there something that I might have built already? If you have a high cost of maintain and a high cost of run of a commodity solution, you should be looking at replacing that solution. One thing that comes to mind, an example might be logging. You might have your own logging system, or you might have your own billing system, whatever it is that is proprietary, and you might not be thinking about replacing those. But if they have a high cost of, if they're constraining you from creating packages that are flexible, if they're constraining you from being able to do some of the innovative things we talked about, which is creating kind of smaller packages or adding on to solutions or integrating, and you have to do a lot of development against them to be able to run them or maintain them, you should be thinking about replacing them. It will be a one-time cost, but it will reduce your total cost of ownership or your runtime, which is something that you need to be looking at. You may want to partner on a solution that is a white label as opposed to a sell with or sell through. And you might, and maybe you only do that for 2 years. It doesn't have to be forever, right? Selling a solution, an embedded solution for 2 years while you replace it later is a common strategy. Just make sure that you're surfacing that information and ideas associated with that. And when you're presenting it to your leadership team, make sure you're analyzing all the cost, which is the one-time build cost, the run cost, and then from just an operate technology cost, but then the cost of updating that. So if you have things in your roadmap that are going to cause you to have to make changes to a particular piece of software, particular piece of code in the future, then you want to be surfacing that, because there's different decisions that they're going to be making because the financial situation of the market has changed.
All righty. So this is the section we talk about how to deal with your investors. And so with your competitors going through the same type of transition that or challenges that you are, so there's an optionality here that you can provide around from an M&A perspective. And so your investors can help, but they can also slow you down. And so typically it's a good idea to get ahead of this and think about it like you would recruiting. So there may be a hunt and target list within some of the within your industry that you'd like Insight to take a look at and understand could they be a potential M&A target. And then the second thing is, from an evaluation framework, provide a quick no-go go evaluation so that you don't get overwhelmed with opportunities that keep coming across your desk. Importantly, if you know something's going to be a buy potentially because it's not core IP, then don't spend a ton of time looking at it, right? Pursue the M&A strategy and then come back to it. If you know that it's core IP, don't get distracted by deals that they come along if you know you're going to develop it, and give guidance to Insight accordingly.
And one thing I want to say on this is, look, if you don't fully understand kind of all the business aspects of M&A, you might be looking at it only from that's a technology solution, and I like the tech, and it doesn't necessarily have a lot of sales or customers today. And you might be looking at something that has a lot of sales and customers, but the tech isn't so great. I think one of the things that you need to do is surface that information about your heat map, about where the adjacencies are, or some of the things that you're thinking about being build, buy, or expand, add on. And if you surface that information to your investment team, one of the things that we can do is we can help you think about funding options that you might not have thought of, M&A considerations that you might not have thought of. There's different deal constructs that are going to be on the table now. There's different ways to look at things. So if you can surface this information, we can have more intelligent conversations with you about different options. We aren't looking at what you consider to be kind of the core tech versus kind of what you're embedding. And again, the more that you surface that information, the more that we can have the conversations with you and give you options. I want to reiterate, you should be spending most of your dollars of product and tech on core intellectual property. That's where your dollars should be going, to creating that moat of the value that you provide as a business. And so if you've created a lot of things that are commodity, or there's things around it, surface that information. Now is the time to surface that information, because there could be things that can be done that were not a possibility before. But I'm going to say it one more time, your core dollars should be spent, or most of your dollars should be spent on core intellectual property that cannot be replicated easily.
And so to that point, right, there are typically two types of play. There's an ARR additive, so if you can pick someone up in a space or in the adjacent space for cheap, which is typically a 1x revenue, that makes sense. On the technology side, if you can do a bolt-on, right, and then where the overlap of those two are, that's really your sweet spot. Importantly, if you've been through an M&A process before where you've had to then go through the integration, you know the things to look for, you know the risk, you know how to mitigate. If it's your first time, it's not a panacea, right? A lot of tricky issues, so make sure you weigh the risks and the mitigation if you haven't been through the process before.
And the one on that too is, as you're looking for those, we talked about it in a previous slide, there's always a partial or partiality to solutions that sell to the same buyer, because you can actually cross-sell. and it's a quick kind of win in terms of the integration and being able to monetize that. So when you are looking at different solutions, try to look at those, or at least put an indication on the evaluation that it's solutions for the same buyer that your current product is under.
Okay. So in terms of a framework, just to be able to map this out from a structural perspective, map out the components from a functionality standpoint in your system in terms of what are the big pieces and what do they do, right? Then look at the competitors and non-competitors in your space and see how they overlap, okay? Define from an integration perspective things that are a go, no-go. So GUI design, data handling, use of microservices, go, no-go criteria for a technology that would be too far afield to integrate, right? So if you're a microservices company and the company you're looking at is monolith based, then it would be too hard, then that could negate a move forward there. And then define some other, sample criteria. Could also be browser support, white label capability, SLA. Supporting 4 nines versus 2 nines is a huge difference, SSO, and et cetera, et cetera. So map those out. And then from a business perspective, as Shelley was alluding to, define how bolting on the technical capabilities, the feature capabilities and the product offering capabilities would impact your current segments and potentially new segments from the revenue side of things. So that's a quick way to look at a framework for a quick go when evaluating potential M&A targets. All right, so I'm going to hand it over to Shelley now. She'll talk a little bit about long-term value, and then we'll wrap it up.
I want to just take a minute for some housekeeping. Again, if you do have any questions, I'm kind of keeping my eye on the Q&A section, which is in the bottom of the Zoom, so feel free to ask some questions there. And then the other thing I want to reiterate to kind of put this into context, I mentioned it at the very beginning of the webinar, but one of the things that you're going to get handed is like, we need to cut these costs, and so here's your lines, go make it happen. And you are maybe thinking about that you have to cut people, or you need to cut, products or things you're working on. And what we want you to take away from this entire webinar is there's many levers for you to choose from. There's not as many levers as a scaled enterprise that you can choose from, but there's levers that you may not have been thinking about before. So putting in optimization to understand, or ops capabilities to really understand all of your costs and where they're going, is an important lever that you need to do. Maybe partnering or building certain things or acquiring certain things versus building. These are all different levers, that you may use to achieve those numbers. And I think one of the things that happens, especially in times like this, if you don't know what all of those levers might be, you might know some of them, but if you don't know all of them, then you quickly go to kind of cutting staff, which may or may not lead to achieving kind of that long-term value. And one of the things that we have to do in a scale-up organization, unlike an enterprise where you have the ability to kind of cut a lot of different things and still maintain revenue and still maintain long-term value, in a scale-up based company, you still have to create long-term value. So if you cut so core to the bone that you are only developing and delivering the solutions that you're selling today, and you're not creating long-term value for things that can be sold onto the customer base in 1.5 years or 2 years, even though they're not buying right now, when the market picks up, and the market will pick up, if you're not creating that long-term value at the same time of kind of getting into those P&L numbers, it will not bode well for the long-term value of your company. So remember, you're still in the scale-up phase, and if others have worked through recessions, they might think, oh my gosh, you must quickly go down and not spend any money. That's actually not the case. What you need to be doing is spending the money efficiently, saving your current customers, and building long-term value. So the things that we talk about in terms of partnership or kind of looking at your roadmap isn't to say cut to the bone, it's to say please make those decisions strategically. And if you have never had to do this before, you may take that instruction in a way that does not open up enough possibilities for you. So that's what we're trying to do with this webinar. Make sure that you're looking at and understand the deliberate long-term and short-term trade-offs. you may have to make a short-term trade-off to sell something that is kind of off your vision. Maybe you're going to sell services because you want to get that cash in the door, or maybe the services need to be sold to kind of cover the complexity of implementation or configuration. You may not want to sell them forever, but you may need to sell them right now. Do it with intention. Make sure that the entire organization knows that you're doing that, why you're doing it, monitor it, and just make sure that you're also maybe chipping away at making that configuration or implementation easier, maybe something that you need to do now for different reasons. You want to be able to maintain momentum in terms of being able to pick up where you left off. I don't mean that you shouldn't change things. I mean that you might have been ready to launch a product in 2 months or 4 months. Maybe now it's going to be the end of the year because no one's going to buy it anyway right now because it's a brand new product and no one's going to take that risk. And so you can reallocate some of the resources to something else and just kind of slow that launch. It doesn't mean you don't launch it. It means that you slow it and maybe even harden it so that there's less risk to your customers because it's a more hardened product. Whatever it might mean, you want to evaluate that. And stop flying blind. Look, I can tell you that most of the companies, you come from startup or you're in an earlier stage of scale up and you just haven't had time to put in a good product ops capability, and you don't have a full understanding of where all the spend is going. And when I say all the spend, I mean everywhere across the organization. How much pain are you inducing to customer success because you don't have something on the roadmap to do something that the customers constantly call about? How much pain are you inducing because you've chosen to release something early? Whatever it is, there's costs associated or data that you should be collecting. Does not mean that you need to act on it. It means you need to understand all of the different levers available for prioritization that are going to have an impact on cost across the organization, internal cost, upside potential, and partnership potential. And often you were so busy just kind of getting things out that it took a backseat to understanding all of that information, and you need to pull that forward because the information is going to allow you to make better decisions in a shorter amount of time and a reduced risk. We can't control what the market's going to do, but we can certainly control what, where, and how, what we're offering today and the cost today, and we can use that information to make decisions faster as things come in from the market that we cannot control. So from a guidepost, 2020 is going to be a kind of a crazy year in terms of looking at predictability. And one of the things that investors do is they look at predictability. You don't want to have crazy swings up or crazy swings down. You want to have predictability in a business and the leadership team being able to deliver on what they say they're going to do. 2020 is kind of a wild card for all of us. 21 is going to be less forgiving than 20. 22 is going to be less forgiving than 2020. And we all know that decisions made in product and tech today have an 18-month to 24-month runway. And so you need to be thinking and letting people understand what it's going to look like in terms of the decisions that you're making now into those multi-year timeframes. Understand what the rule of 40 is, and if you don't know what that is, you can Google it, and we'll happily tell you that. But these are some of the business terms that, as product and tech leaders, you really do need to understand. And some of the best-in-class metrics that we had looked at is that gross retention about 85%. We actually like that much higher at Insight. Typically it's 90. We actually do like that higher, but there's going to be some gross retention dips. And again, some of that's going to have to do with your customers, having to figure out ways to kind of cut costs. Make sure that the retention that's happening is because they're cutting costs, not because there's product issues that aren't keeping you in your customers. And then new bookings, I would say this is something from Crosslake, from a third party. Really be listening to your investment partner and make sure that you know what they are. These are just some things that were quoted from ACG, but in essence, listen to your C-suite and your board in terms of what those metrics should be for your organization. So with that, moving forward, I'm going to kind of recap some of this and then I'll hand it back to Steve. But you must still be creating value. If you are now treading water and you are just keeping up with kind of the current air you have, and you are not developing new value, you need to raise your hand. You need to start having the discussions, because there's things that we can do to help you kind of uncover the value there, or just different ways to think about it. It's your business and your strategy. We can just give you ideas and kind of ways to think about that differently that you might not have been exposed to if you've networked in this type of a recessionary situation. As a C-suite, it's your responsibility to kind of speak the language of business, and it's not the rest of the business of the C-suite to speak the language of tech. So you need to kind of make sure that you're translating it. You may not be able to do it in the short term, but we will actually help you do that. And then going forward, you will be able to have that language to be able to speak to them. We want to help you with what you're trying to say to them. If it doesn't come out, we want to help you translate that, because in essence, we know that that information is extremely valuable. And if we can help with the translation to what that means in business speak, you probably can come out with a much better solution. So let us help you with that if you need that. Again, the community is a great way to ask those questions. Again, stress it enough, data decision making is extremely important. If you need help advancing your product capability or kicking one off, that is something that we help with, and it's important to us, and that our portfolio companies are doing that. Leverage your investors. Look, they know what's happening in the market. They're looking at industries. They're your biggest champions, and they also have information, and Insight is a very friendly investor. If you haven't worked with Insight in a long time, one of the things that Insight is fantastic at doing is really being a partner to the portfolio companies in all ways. And so if you have some questions about how to interpret some things that were said here, or things that are happening in the market, or potential options, please ask your Insight representative. And then make sure that you know the success criteria that is specific to your company, but also be helping to influence that. Steve, anything you'd like to add?
Nope.
Okay, great. So Crosslake, as I said in the beginning, is a partner to Insight. We do work with them on a lot of kind of M&A when you're doing M&A for your existing companies as well. Sometimes they're hired directly by the customers or portfolio companies, sorry, to help with M&A, and also kind of post investment, technology, big technology, things that you might need help on. They are offering some free consultations of some of the things that we talked about today. And specifically, again, I want to reiterate, kind of help thinking about how to get something across the line to the leadership team that you've been maybe trying to help them understand that is a big shift, and it's just not kind of getting over the line. I think that's a really great thing to kind of have some free consultation with Crosslake. They can kind of help you with that, and can also tell you that there might be different ways to look at it, or perhaps you might be thinking about it a different way. But they definitely are a friend to investors. They're a partner to Insight, but to many other VC firms as well, and I encourage you to reach out to them.